It's one of the biggest earnings weeks of the entire year, and the results from companies like Apple, like Meta, Microsoft, Visa, and Starbucks have the ability to set the tone for the entire market. So in this video, we're going to be looking at a few key stocks that I pay close attention to and discussing what we need to be looking for in these earnings reports. The reality is, like we saw last week, earnings reports really have the ability to move stocks in a short amount of time. For example, Google had a stellar earnings beat last week and the stock is up 8% in the last 5 days. And as you might already know, the guidance that management teams give during earnings reports are absolutely vital to investor sentiment. So one of the big questions we'll have to ask is, how are tariffs going to impact management guidance? So we have plenty of stocks to get to, so let's go ahead and jump in and talk about one of the stocks in my personal portfolio, and that's going to be Domino's Pizza. Now, Domino's Pizza is a stock that's reporting Monday morning, so depending on the time you're watching this video, they might have already released their latest quarter's earnings. Now, when it comes to Domino's, they were down about 1.5% in the last year, but year to date, way outperforming the market, up over 16%. Now, what's interesting is if we look at the earnings report from last quarter, they missed on top and bottom lines, and this is a very rare occurrence for Domino's Pizza because over the last 2 years, Domino's Pizza has beaten earnings per share estimates 88% of the time, and they've beaten revenue estimates 38% of the time. Now, like most stocks we can see in the last 90 days, there's been a lot more bearish sentiment due to the talk of tariffs, which would likely increase costs. And we can see if we look at earnings per share revisions in the last 90 days, we have 12 bearish revisions and 7 bullish. Now, what's impressive about Domino's Pizza is if we jump over to my profitability sheet, come up here and plug in Domino's. What we can see is over the past decade, revenues have grown at a high rate, going from almost $2 billion all the way up to about $4.7 billion. And in the midst of this, the gross profit ratio has climbed quite a bit higher. So the end result of a climbing gross profit ratio and climbing revenues is obviously going to be earnings growing at a very high rate. And that's exactly what we've seen from Domino's over the past decade. So one of the key things we'll have to look for is cost management. Will management make any statements about increased cost and a potential decline in gross profit ratio? Along with this, we're going to be watching closely for growth with US stores. The reason behind this is management stated that with the plan we've developed, they believe they will deliver US same-store sales growth of 3% or more annually, along with 175 net new stores. This is a direct quote from last quarter's earnings. They believe if they can attain this, they're going to be able to capture additional market share gains in 2025 and beyond. Next, on Monday, we have Waste Management. Now, Waste Management is expected to report after close on Monday, so we'll go through the full trading day before hearing their report. Now, what's interesting about Waste Management is investors aren't overly concerned with the talk of tariffs in relation to this company. And in fact, this company is generally considered somewhat recession-proof, and when we look at these returns year to date, you can see why. Up about 13% when the S&P 500 is in the red in 2025. Now, when we look at Waste Management, we can see over the last 2 years, they have beaten earnings per share estimates 63% of the time, but have only beaten revenue estimates 38% of the time. But if we look at those earnings revisions over the last 90 days, 13 bearish revisions with 0 bullish revisions. So sentiment around this stock, at least according to analysts, has really shifted. Now, in my opinion, there's 2 key items we need to pay close attention to when it comes to Waste Management. Starting out, the company announced last year they're going to be acquiring Stericycle, which was a leader in medical waste services, and they bought them for about $7.2 billion. And this acquisition was completed in November of last year. And here's what we need to pay close attention to. The company stated that this acquisition positions us well to strengthen our operating EBITDA and cash flows. So in this upcoming earnings report, we're actually going to be able to get insights into how Stericycle is actually operating under Waste Management. Again, the company spent $7.2 billion, which is a significant portion of their cash flows every year. So obviously, they're going to want to see strength from this sector. And then the second point we want to watch for. In last quarter's earnings report, management stated they expect free cash flow to grow more than 17% at the midpoint of their outlook for 2025. That is very high free cash flow growth. So essentially, we want to make sure that management reaffirms that they're still on track to hit that point, because if so, I think investors are going to really like that news. Now, keep in mind, if we jump over to my free cash flow analysis sheet and come up here and plug in Waste Management, what you really need to understand is Waste Management's cash flows are not consistent, so don't be overly concerned or overly optimistic if it's not what you expect in the upcoming earnings reports. Again, there's going to be fluctuations. And then on Tuesday, we have another holding in my portfolio actually, and that's going to be Altria, stock ticker MO. Now, Altria is going to be reporting before market open on Tuesdays, we can see right here. And there's a couple of things that we need to look out for in regards to Altria. Now, to start off, in the last year, the company's done really well, up almost 34%, not even including dividends, which would probably bump that up by about another 7 to 8%. Company's currently trading at about $58.26, and year to date, up about 11.4%. Now, if we jump over to the dividend breakdown, let's come up here and plug in MO. Again, what we know about the company is they have a high starting dividend yield, and the sustainability of that dividend yield is always going to be the focus for this company. And what we can see, while the free cash flow payout ratio is about 80%, management team has stated this is exactly where they intend to have it. And we can verify this is true because that's pretty close to where it's been for the past few years, at least since around 2019. So free cash flow has continued to cover those dividends. Now, management has stated they expect about 2 to 5% earnings growth, so we can probably expect free cash flow to be in that range as well. So obviously, we want to make sure it stays in line with that growth projection. But on top of this, what we really want to pay close attention to is the e-vapor market and what's going on with illicit products. Let me show what I mean. They estimate that the e-vapor category grew by approximately 30% in 2024. That's a pretty rapid growth rate. But then they stated that illicit products represent more than 60% of that category. That's not good news for Altria. If we look at the recent earnings report, they state, in the simplest terms, we believe the regulatory structure is broken and the tobacco marketplace is not operating as Congress intended. The FDA has not authorized enough smoke-free products to meet consumer demand with legal products, and regulators are not holding bad actors accountable. Illicit product manufacturers, distributors, and retailers have yet to experience any material consequences for violating federal laws and regulations. This will be a key aspect of the upcoming earnings that we're going to want to pay close attention to see if anything has changed. On Tuesday, we also have one of my favorite stocks of all time, Visa, reporting their earnings. And in regards to Visa, they're actually going to be reporting after hours on Tuesday. Now, when we think about Visa, I have to be honest, I think it's very unlikely we see anything in this earnings report that would make me feel uncomfortable with holding this stock for the long term. But with that being said, there's potential short-term headwinds, not necessarily due to Visa, but due to the macroeconomic environment. For example, if we look at the Consumer Confidence Index, it's gone down quite a bit in the last few months. And the risk here is, if this continues to decline, we could see transactions and payment volumes slow in the coming months, which would obviously be a risk to Visa. But still, even with that being said, if we look at earnings estimates for Visa over the last 90 days, we have 14 bullish revisions and 11 bearish. The third stock I'll be watching closely on Tuesday is going to be Starbucks, and this is another company that's going to be releasing their quarterly earnings in after hours. Now, Starbucks is a unique situation right now. This company is certainly in a turnaround play, and they just brought on a new CEO last year. And if we look at them in the last year, down about 4.5%, and year to date, down 8%. Now, what do we need to be watching for in this upcoming earnings report? Well, we need to put things into perspective. What was going on in their recent earnings report? Well, I want to show you what's been going on with Starbucks. In their recent earnings report, if we look at the North American segment results, they had negative 4% change in comparable store sales, negative 8% change in transactions. Change in ticket was up about 4%, so each sale was bringing in a little bit more money, but that's not enough to make up for the change in transactions, change in comparable store sales. And even though change in ticket was up 4%, look at the operating margin. It was 16.7% when just the previous year it was 21.4%. That is a huge decline in margin in just a one-year time period. And if we scroll down and look at the international results, it does not get any better. We can see declines in comparable store sales, transactions, and even ticket price, and a decline in operating margin. So there's no doubt Starbucks is certainly in the midst of a turnaround play. Now, if we look at earnings expectations for this company, we can see 0 bullish and 28 bearish in the last 90 days. Now, what's interesting is last quarter they did announce beats on top and bottom lines, but those expectations were pretty low. And if we look at expectations for this upcoming quarter's earnings, it's coming in at 49 cents. Let's put this into comparison to recent quarters. If we go ahead and jump over to my quarterly data tab, we'll come up here and plug in Starbucks. Let's zoom in and take a closer look at these earnings. Now again, like I just said, we can see expectations coming at 49 cents. And if we look at the previous quarter, it was 69 cents. The quarter before that, 80 cents. The quarter before that, 93 cents. The expectation is 49 cents, and the company hasn't reported that low of earnings since literally Q4 of 2020. So expectations are very low. So the reality for Starbucks is expectations are very low. And honestly, in some ways, going into an earnings report, that can be a good thing. If the company can show any signs of life, I think we could see a spike in the share price. I think the opposite of that is also true. If they don't beat on earnings, I think we could easily see a 5% price swing. And then we come to Wednesday, which could potentially be the most important day of the week, with Microsoft and Meta both reporting their earnings. And what we can actually see is Microsoft is going to be reporting after close, and the same is true with Meta. So that's going to be a lot of breaking news at the same time. Now, if we look at Microsoft, what we can see is in the last year, they're down about 1.8%, and obviously, like most of big tech, have sold off in 2025, down by about 7%. Now, when it comes to Microsoft and Meta, there's going to be one key thing most investors have in mind, and that's going to be their capital spending trends. Microsoft, Google, Amazon, Meta, these are companies that are projected to allocate nearly $300 billion to capital expenditures this fiscal year. And while the companies have committed to maintaining that pace in 2025, Microsoft did recently move to halt some data center projects, suggesting that tech firms might be rethinking some of their investment plans. Now, if we look at earnings projections for Microsoft, we can see we have 20 bullish revisions and 11 bearish revisions in the last 90 days. And the company is also expected to grow revenue and earnings at about 10% year over year, which we can see historically has been no problem for the company. Now, when we look at Meta, this is actually a company that's still up 24% in the last year, and year to date, again, like big tech, is sold off by about 6.5%. And like we just mentioned, investors are going to be paying close attention to the capital spending trends for Meta. Now, the other key item that I do want to point out with Meta is if we jump over to our stock screener, let's come up here and look at Meta. Pay close attention to what happened in 2022. We saw a clear dip in earnings, and we were technically in a recession in 2022 with 2 quarters in a row of negative GDP. And what happened here? Well, a lot of advertisers greatly reduced their advertising budget, and Meta generates nearly all of its revenue from advertising. So if we did start to enter more of a recessionary period, marketing departments would certainly cut their advertising budget, and that would obviously be a huge hit to Meta. So it'll be interesting to see if we hear any comments about this potential threat. But with that being said, Google does have some similarities to Meta, and there didn't seem to be any problems in their earnings report. And then on Thursday, we come to Apple's stock, and Apple's going to be reporting after hours on Thursday. And if we look at Apple in the last year, they're up about 23%, but year to date down about 16.5%. Now, the big news surrounding Apple is they are heavily reliant on China for its supply chain, which obviously can face risk for multiple reasons, but right now the huge concern is what will that look like with tariffs. I think there could still be concerns there even if Apple is exempt from tariffs. And what's actually pretty ironic, in the recent earnings report, right before they gave guidance, they said, "The color we're providing today assumes that the macroeconomic outlook doesn't worsen from what we're projecting today for the current quarter." Well, unfortunately for Apple, the macroeconomic environment does look a little bit worse. But that being said, they did state, "We expect our March quarter total company revenue to grow low to mid single digits year over year." So the underlying theme we've been seeing with Apple over the last few years is growth is really starting to slow down. If we jump over to our stock screener and look at Apple, look at the earnings per share over the last few years. 2021, 567, 615, 616, 611. It's been very stagnant, and they're still projecting low levels of growth. And with that being said, are they going to still hit those low growth expectations with weakness in China and weakness in the overall economy? Well, if we look at earnings revisions for the company over the last 90 days, we have 5 bullish and 21 bearish. So again, it'll be interesting to see if they change guidance and what the China environment looks like. And then on Friday, I'll be watching the oil stocks Exxon, Mobil, and Chevron, and these are both companies that are going to be reporting before open on Friday. If we jump over and look at Exxon Mobil, down about 10.5% in the last year, and year to date has traded relatively flat despite the recent sell-off over the last few days. And if we look at Chevron, it's down about 16% in the last year and saw a pretty significant sell-off again in the last few days. If we look at them year to date, now down by about 4.2%. Now, when it comes to both of these oil stocks, a lot of it's going to boil down to one thing. What is oil demand going to look like, and what are oil prices going to look like? Because the earnings of these oil stocks are highly correlated to the overall price of oil. And if we look at oil prices, at least since mid-2022, they've continued to climb lower. And in fact, if we look at just the last year, it's really declined by quite a bit, going all the way from about 82 all the way down to 62. This doesn't really bode well for the short-term profitability of the company. And in fact, if we look at earnings estimates, we can see with ExxonMobil, we have 9 bearish revisions and 7 bullish. And then if we look at Chevron and look at their earnings revisions, we have 10 bearish and 4 bullish. On top of this, for these oil stocks, investors are probably going to be paying close attention to what the spending for these companies looks like. But there you go, those are 10 stocks I'm going to be watching closely over the next week as they report earnings. And those are some key highlights of things that you should be looking for. Even outside of those 10 stocks I mentioned today, there's still plenty of other important stocks reporting earnings. Like always, if you'd like to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight to your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.